Welcome everybody to our Wednesday webinar. A reminder that our Wednesday webinars are where we share what we believe is going on. But we want to make sure that you're aware we are not financial advisors, we're not tax consultants, we're not lawyers. We are folks that try to honestly share what we believe is going on, but we want you to know that you need to get your own financial advice for anything that's happening, any investments. Please make sure you do your own due diligence.
Yes, thank you, Trevor. And we'll be talking about fund structure, SST, legal stuff. So again, consult with your attorney as you make decisions and review projects. All right.
All right. So who is getting excited for the Massive Capital Virtual Conference? It's pretty amazing. We're super excited about it. This is our fourth one now, and it's pretty exciting. Sharar's going to go a little bit over the agenda. I put the link here where people can sign up. This is on May the 10th, and it's a full day. So you know what we do in an hour? Well, imagine 8 hours of that, okay? So get your coffee, make sure you got your notebook. So go ahead and just talk a little bit about what's happening with the agenda.
Trevor, thank you. We wanted to give you a 360 view of the industry, focusing mostly on multifamily, then debt and equity, and also retail, new construction as well. That's the agenda that we have. Tentatively starts at 9 a.m. We go all day down to 6, pretty back to back with one break in between. And then we blended the audience or the speakers from institution and also folks who own large assets. We have Neil coming in, then we have Rod Khalif and also Brad's going to come and speak. And again, based on what they see from their perspective, each of them owns quite a bit of portfolio, and they also raise. So we'll talk about what's really happening, what they're seeing inside of the portfolio and also outside, and their perspective moving forward. And also we have a huge set of institutional folks coming in from Gray Steel, IPA, John Burns, and Hart Homes. As you know, the Old Capital, RealPage, and Realty One. Our request to them was, as they come out and as they come and present, let's drill in more than the view of the world that they see and share additional sets of data. The Gray Steel they have done great presentation last couple of times, and as some of you guys know, the data that they share, it's really awesome. So please join, sign up. It's free, and then a VIP gets the video. But that's all on the website. Would love to have you guys. And last time I think we had a little over 350 people signed up.
Yeah, it was amazing.
Just amazing. That's good. So. And again, whole ideas that give you guys the data, a forward-looking view, and also the current market status purely based on the data to support. Right? All right, let's go to the next one. Trevor.
All right, so we have our next master's class. For those of you that have been following us, we were calling these hackathon. Facebook does not like the word hackathon. So we kept getting blocked on Facebook. So now, again, as we're massive, these are the massive master's class. This one is pretty special because we've been working on this for a while, and then to finally get it to happen, this is actually going to be held at Rice University. So it's going to be a great venue, and even cooler, a bunch of their MBA graduate students are going to be joining us for this particular session. So we're super excited. It's an all day, and anybody who knows anything about property management and asset management, this is crucial. This is where you make the money. You know, we talk all about finding a deal, doing a deal, closing a deal. The real work starts when you close a deal. So again, Sharar will go over a little bit on the agenda here.
Trevor, thank you. So I know I did my MBA at Rice, and we went out and we're working with the Rice alumni group quite a bit, and they gave us a space. It's the unconventional thinking. Once you walk into the space, that's the tagline. So what we wanted to showcase, take you guys through a journey. So we like to do a scenario playing, which is what happens. Can we condense the life cycle of 5 years of journey of the asset management into a day, just to give you guys framework what happens. So we'll start the day with the expectation, our view of the multifamily and what we're seeing. Then We're going to talk about deal structuring and a hypothetical project that we're going to run and how the deal structure looks like, who's going to be our team. Then we'll get into the operations. Then we'll get into how do we set up KPIs, both on the asset management and also the property management, and how do you put the system and a tool in place. Then we'll talk about the conflict resolution. Typically, we talk about hiring, firing property management companies. What if the sponsors? What if the partners, right? So we'll take you guys, some scenarios about how to go about it, how to put the legal structure, and then we'll end the day with talking about outside the team, how do you manage the relationship with lenders and the investors and city and the insurance companies, some do's and don'ts, from all categories. Then we'll wrap up the day and we'll have the networking afterwards. So we're looking forward to it. It's got a lot of information, a lot of fun, a lot of stressful time as you go through the scenarios. Last two sessions, it was of the last session, we optimized the schedule with about 15, 20 minutes of information presentation and about 20, 30 minutes of workshops. As you guys, of all of the folks who have been in the room, they get to do an exercise of it. So yes, bring the laptop. We'll give you all the data. We'll crunch the data, and we'll go through an exercise as we go, and plus a lot of role plays as well. I believe our capacity is about 85, 90 people, and we have already a little over 35 signed up. So I think, and we just opened it last week. So if you're in Houston, come by. If you're not, but about to buy an asset or having some of those scenarios, come by. We're happy to share what's going on our end of it.
Yeah, and this is only in person. We haven't quite figured out how to do it virtually yet. That's a lot more. We do our days, but because we tried to make it very hands-on where people work in groups and do different things. So yeah, but definitely join us. We will be running the series again in Dallas. And yes, I'm sorry for those that don't live in Texas, but that's everybody's moving here. Just come on, break down and come and join us. So today we're going to talk a little bit about massive capital. Our topic today is, we're going to talk about value add, our investors and partners. Today's topic is direct versus funds. Very timely topic. There's a lot of folks doing funds. We'll have plenty of time for Q&A. And again, this is going to be a very high level view of a very complicated topic. So I want to make sure that we do that. Okay, give you that that we're not going to be able to go deep. That going deep is going to take longer than we have tonight. All right, so Massive Capital itself is a vertically integrated real estate company specializing in ground-up construction, retail, flex space, industrial, mixed-use multifamily. We are an owner-operator for value-add multifamily. Yes, you can see we're very Texas-centric. We do have assets in Denver. We're actually going to be up in Denver the first weekend in September, second weekend. There's a conference up there, so we're going to go up there. We'll do a couple of meetup events and tours of our couple of properties there. We have assets in North Carolina and Warner Robins, Georgia, which is just south of Atlanta. And we have been looking at retail in Tampa and the Phoenix area, but have not pulled the trigger on anything yet. So if you look on the left-hand side, Massive Capital is equity fund. Brokerage is on the triple net retail and industrial space. Same with the property management and development, construction. We have a tech company now where we can do lots of things for you. And of course, we have the Massive Mastermind, which is an amazing program. So if you look at our sister company, Realty One, you can see their assets. They're about 290 million. Then you look at Massive Capital's assets, we're about 203 million. Super excited. We'll have photos soon, but they're about to start work on XSpace. It's one of my babies. I was so excited about XSpace, and they're going to start going vertical soon. I think I mentioned it last week, but it's quite astounding. We had to pull 88 separate permits. 88 separate permits. It's kind of crazy. This is the team behind the team. So we have obviously a lot of people. We have some people doing this. Has been reorganized a little bit. So across the top row are the ones that you would deal on a regular basis. David now is head of our asset management. Ellen, we have our financial team here. A lot of the team on the brokerage side for Realty One. Ramesh and his whole tech company. And then most of the folks in the bottom are project manager, construction managers, all to do with the construction side of Realty One. We have our team, Shirar, Sanjay, and Mike. And then we have the Realty One team, which is Bo, Pat, and Alexis. So we closed 15 properties in 22, 23. We have one under contract in Midland, Texas. This one's a little bit unique for us. This is the first time where we're really just a KP and experience role. We'll definitely be helping them on a high level on the asset management. We have a new development in Conroe, Texas. We have LOIs pending in San Antonio and 2 in Houston. Our value add opportunity in San Antonio. We rebranded this a little bit, trying to get a better message out there. So we're closed. We're taking new investors, and it's to fund the CapEx. A lot of people say, how can you close and you still need money? Well, you close and sometimes you continue raising money. And what we need is to finish up the CapEx. We're super close. We're actually about 93% subscribed right now. So this should be done by mid this month. So it's a great investment
Electrical?
and group learning. So do you want to do this one here, Shirar, or
Yes.
are we going to?
Let me go back. Thank you, Trevor. So really appreciate it. So the massive value add, how do we add value? And for our philosophy has been, it's a group learning by actually doing, right? We want to talk about what is happening in our world, what we are learning, what's working, what's not working, and we share that with you, so you can do the same thing. So we had a couple of questions. What is the objective of this Wednesday? The webinars, it's all about how to get started in multifamily, right? So within the multifamily, there are typically 3 ways you can kind of get in. On the left-hand side is the LP as a limited investor. Most of the folks who join our one-step call, they're on this bucket. And then we have another way of coming into multifamily, which is the lead sponsor or co-sponsor. That's we call a general partner. And the last thing is you buy directly, you do a JV, and or you buy with your own money, the whole thing by yourselves. For a massive side, anytime we have less than 4 partners, we use a JV model, and more than 4 partners, we use the syndication model. So most of our conversation that we talk about here, it's from the syndication perspective, how to get started in the multifamily as an LP and or a general partner. Then once the call that we have, a Thursday call that we have every other week, that focuses on mostly on general partner. And in this call, it's mostly LP, but we give you a blend of the general partners as well. Okay. All right. So, we always look for partners. As of now, we have been blessed with a fantastic set of partners that helped us, to get here, and we continuously, working towards to add value. And one of the way we add value by bringing in the skill sets in our team, so we can say, hey, we have skills to execute whatever project that we want to get in. So we buy land, as some of you guys may know, and also we do retail JV development, Class A, 2 to 40 acres, with road frontage, not gentrified, rather it has been proven. Case study. One of the founder of Keller Williams, Joe Williams, we met with him in December. Then, from the massive side, we continue building the relationship. They came to see our office, so met with us last month. About a month and a half ago, and then they came back out today. So I spent about 3-4 hours today with Joe Williams and his right-hand person, Richard Gary, to walk one of our town center developments, so that we are working towards a JV partnership for one of the developments in Austin, northeast side of Austin. It's about 31 acres of retail Class A development there. So that kind of a project we can do. And also we are working on City of Georgetown to do some of their projects as well. Again, Class A, if you have any land, you're looking for a partner, we can come in, do the construction, do the lease up, and we can bring in the balance sheet to take on the debt as well. And then most of our conversation here, it's about the multifamily. As Trevor was talking about, look at the number 3, we do balance sheets, but we also do asset advisory, and we do a new acquisition. Our typical buy box has been 1980 or newer, 150 to about 350-ish units, pitch roof, no coastal areas. That has been our core focus, but we're small enough to move around it if the price makes sense. So for us, everything is risk adjusted. We'll talk about some of the ways we take a look at it, but our core focus has been, and the price point, it's about $15 to $35 million, but comfortable, or that the center point of the gravity seems to be about $20 to $30 million. That's where most of our deals are coming to fruition, where we're sending LOIs. last but not the least, we have the education, which we call it Massive Masters. It was an interesting story, but by the time I get to the Masters, it's like we like to play chess, and running an organization, running a project is almost like playing chess. So we thought, hey, Grandmasters, Masters, that's the name we kind of came about. Okay. All right, Trevor. So I would say be ready for the survey. We have a survey coming up shortly. So today's case study was on how to, if we are an LP and we want to invest. Now the question is, do we invest in a multifamily directly into the project or via a fund, or what's the difference, or how do I understand what happens where? So we'd like to give you that flavor of it. We'll try to stay in a high level, and we'll try to go down maybe 1 or 2 points and drill into it. Whole idea is that introduce topics or introduce ideas or concepts to you, so that when you get into a point where you want to invest, you can ask the right questions. And again, during the Q&A, we'll ask you more questions as we go. Okay. All right. I believe there's going to be a survey out. Whenever it comes out, we request you to fill that out. We appreciate it every time you do it. We try to hit that 70–80% mark. And every time that comes about, we gather data, we get your feedback, and based on that, we optimize our sessions as we go. Okay. All right, so let me move to the next one. Okay, so setting up the scenario that for most of the multifamily deals that we do is 3 to 5 years of cycle time based on the underwriting. And that's based on the market view we have as of now. If you do a new construction, it's typically 3 years. If you do a value add, it's typically 5 years. If you do a value add above 350 units, then it becomes even slower. So more the unit count, slower the ship, longer it takes to turn that ship around, and that's how we manage it. Now, if the market gives before that, then it's fine. But from us perspective, it's 3 to 5 years for most of the deal that we underwrite. And we break out every single multifamilies in about 3 buckets. The first one is the acquisition, and the second one is the debt and equity, which is what we want to buy, how we want to put the debt and equity together, because debt and equity together sets the stage for how we are going to operate. And not if I have a pref, I have to behave a different way. If I have an LP, I'll and our financial structure will behave a different way. And if I have a JV, our financial structure will behave a different way. So again, everything leads into another one, right? And also based on what we buy, we'll set the stage for how we manage. And a class A or class B or above it's a different kind of property management company, a different type of value adds versus a class C versus a new construction, right? So everything has a dependency as we go. And for the Massive Masters, our goal is to have 20 to 40 general partners every year that we add. And the whole idea is that we add value by providing tools and a skill set, because in this market, it's just tough to play solo. And once you buy 1, 2, 3, it is just everybody's out of time. Then how do we optimize that and add value to the investors that we have? So today's topic is going to revolve around the equity on the debt, which is we have equity and we are going to deploy the equity, and how would that look like, right? Okay. So this is a meaty slide. I'll take my time a little bit and I'll walk you guys through, and then I'll simplify a slide after. The whole idea is that how does equity come into a syndication? Because most of the property that we buy, it's via the syndication route where we aggregate money and then we do the acquisition. So from left to right, usually it's a 506B, which is we have a relationship. And then we have a 506C, which is it's a accredited or sophisticated investors who don't have to have a prior relationship. Assumption is they already know what they're looking for, they understand the risk, and there we go. And JV is referrals and partnerships. Now, don't ask me the logic behind 506B and a C from the feds, because everybody buys stock on a 506B, right? So almost all of our, I would say all of our investors, they're as sophisticated as 506C, but hey, rules are rules. Now, left to right, it gets more complicated and it takes a longer time, and I'll give you the matrix. And also when the equity comes in, we have about 4 different types in general equity comes in: 1031, then directly into syndication, an SPV, and a fund. So we'll talk about these 3 section most of the time. And the last one is the lender, specialty, or family office. One partner comes in, let's say on the Realty One, right before Christmas time, they bought a piece of property. It's about $13 million all in, and one family office came in. They gave a check for the whole thing, and that structure is different than that, right? Then again, top to down, it's more complex it gets. So left to, on the top from left to right, it's more complex. From on the equity source perspective, it just takes time as you go. Okay, so from 1031, 506B and C, it's all independent because 1031, they come in on the JV structure side. Typically, it needs a, when we say how, it need whoever receives the money from the syndicating team, they gotta have a good network, they gotta have an old relationship and enough confidence for the LPs to come in as a 1031. Usually 1031 it takes time to get there. And it's very risky from the ownership perspective because 1031 on a residential is different than 1031 on a syndication. It's a lot of work that goes in. You got to structure the property a different way. You have to revenue share differently, and then both party has to be comfortable with it. So what we do, if someone says, I've done a 1031 and I want to do another 1031 in syndication, we ask the question, have you done in a 1031 in a syndication? If the answer is no, we'll take it through an onboarding process to make sure that everybody's comfortable before we trigger any legal work. The last thing we want, we go through the legal process, you go through the legal process, and during the closing, something will happen, right? Even though it's a normal case, the first time to the investors, something may happen. Then we said, okay, let's do the onboarding and we go. But from LP side, it's a healthy thing. It's a good thing. You should do it whenever it makes sense. You just need to be comfortable about the paperwork, the way the syndication docs are being set. From the GP side, it's a risky, so you have to manage the risk because what if it doesn't happen at the end? If it doesn't, a big chunk of money that goes out the door. Right, and the direct syndication project, typically friends and family on a 506B, as you guys know. And then we met them via the networks and webinars, and 506C, we met them in a social media conference, whatever way that we kind of collect. They tend to invest more than a 506B. Statistically, I think, don't get me wrong, almost 50-60% of our investments are from 506C. Even though a good chunk of them are 506B already, so we have a relationship, and the average check size is a little bit higher than the 506B. But 506B investors, they understand more and they make a decision quick than a 506C. JV partner, and this one, JV partner referral, it takes a lot of work, a lot of interviews, a lot of going back and forth, and then they come in. We're bringing in a $2.5 million check as a JV partner for one of our projects. It took us almost 6-7 months of relationship building, then job interviews, like we interview them, they interview us, we role play, then we figure out it's a good, solid partnership. It takes time, but you have a meaningful size of dollar as it comes in. SPV is very similar to directly coming in. It's a little bit more structural differences. I'll simplify it. And then funds are same, very similar to directly coming to syndication, but the design of the legal work is different. Lender and specialty, it just takes time. It just takes time. They don't come in easy on the family office. And then again, they are as tough as much of a time as the JV check. So when you hear, I want to go to family office and there's going to be one family office, they're going to back us up. We would say good luck for your next project. We might want to plan that for project number 3, 6 months, 8 months, a year from now. Same, case in point will be the Joe Williams office. We've been at it for our relationship is building over time, 6 months, even though Realty One, it's a 42-year-old company. They have over $300 million worth of asset. We have $200 million worth of asset, but still, it takes a lot of time to do that. So if you are coming in new into the game, just give yourself enough breathing room when you go. So very intentional about it when you say you are going to go, family office and or specialty lender who has a bigger check. That is true, but the check may not be for you right away. So work on it, and the speed may not be as fast as you may think, right? So that's the typical way we deploy the equity, or as an LP, we invest into a deal, and as a general partner, we receive money. It's a little complicated, but I will simplify it as I go through. And as I quickly go through, please drop the questions in the chat. We're gonna come back and recap those the questions as we go. All right. So let's simplify. What does that mean? Like a very simplified model. All right, here we go. So flow of money. So we're an investor and we have 4 investments, A, B, C, and D, whatever the investment is, right? Now we're going to invest in that money. Question is, how do I invest? First thing we can do, I can directly invest, right? Massive Capital has an example. Massive Capital has Horizon. I'll use a name. And investor Joey wants to come in, and investor Joey said, I have some money directly. We have another, we just closed out Harris Ridge. If Harris Ridge would have been here, then we have another one, then you go. Or Massive Capital has one in another, sponsor ABC, they have one. What do? You invest directly and you sign one document that is being crafted by the SEC attorney, and that is it. Second option, same investor say, you know what, I have some more money and I'm going to invest, but I'm not going to invest in one. I may want to invest in multiple. So what they do, they give the money to fund, and fund goes to 2 projects at a time, right? So that's the flow of money. Then we'll talk about the differences between those two and who does what where. So again, as investors, you guys have options. You may choose to go, I'm going to one discrete event at a time, or I'm going to do multiple at a time, depending on what it is. Then there is another one in between, which is SPV, Special Purpose Vehicle. What they do is it's a fund, but it's only for the investment C. So depending on who is the capital allocator, who they're structuring it, it's that, right? So as we think about the fund, when you guys, as an LP, someone says, and invest in my fund, you ask, is it a fund of fund or is it an SPP? How is that being structured, right? So in general, that's the 3 ways outside the JV, you'll flow your money, right? And then let's go to the next one. Okay, how does that look like? On what's my benefit, right? So, okay, so this is an example. I changed the bottom sections of it. So we went from investment A, B, C, D. I said, okay, let's use some concrete examples. So we said, okay, investor 1 invested, two projects, DFW multifamily. Again, I'm just using an hypothetical name and an asset category, and then and/or triple net. All of a sudden, your portfolio has 2 kinds of project. Same investor, maybe it could be another investor invested in a fund. That fund went to new construction and Houston. So one shot, you got 2 different types of project, and 2 discrete shots, you get 2 different kinds of project individually. And maybe that investor went to a fund manager who has a SPV only for the multifamily, right? So let me use an example with the number. So let's say someone has $50,000. You will have 2 options. Do I choose DFW multifamily, or do I choose a triple net? Same 50 could be coming to that multifamily project via a fund, right? And same 50 could go to a fund on the left, but then you can split 25-25, right? So it all depends on what your appetite looks like, what your understanding looks like, what your existing portfolio looks like, and how you want to build the portfolio. So to keep things simple, typically on the right-hand side, this is where you see, let me go back a little bit. This is what you see mostly. It is simple, it is standard, not an issue. Fund, it's a complicated, it's a little more experience heavy. And that's a true fund manager, right? You know what we call it. If you're from the engineering perspective, if you don't know what it is, go right to left. A fund manager is a manager of a fund that individual knows, good, bad, ugly. They have continuous deal flow. They have continuous investments going on. And so they just continuously raising as you go, versus right, it's one and done, right? So this is a little bit more mature play. And, but this is a business as well. And everything has pros and cons depending on how you take a look at it. So going back, you have options. Now, the question is, why will we do this versus anything else, right? I mean, what's the why? So the answer is the way we choose right side directly versus left side fund is because of this slide. And this is what we call a finance perspective. Returns do not matter. What matters is risk-adjusted return, how much risk we take and how much return we got, right? So not all 20% return are made the same. If you have less risk, make 15%, and high risk, make 20%, then you should take the 15% because you have less of a risk, right? Your ratio of risk is much taller than this. So here, So on the x-axis, number of stocks or number of multifamily investments. On the y-axis is your risk, right? And total risk is systematic risk, unsystematic. Systematic means it's a market risk. Market risk in multifamily will be population growth is happening, and then people are moving into a town, and they're going to pay higher rent if I have a better product. That's my systematic risk. Nothing I can do about it. How many people moves into it, but I'm going to ride with it. And the unsystematic risk is that project risk. I'm buying a value-add product. I need to invest. I need to execute a $3 million CapEx in 6 months or in a year, and I have to manage the property efficiently. That's my systemic or project risk. What we call it, that this systemic risk, that's what we get paid for. This bucket, we don't get paid for it because it's extra risk. So what we have to do, we have to keep on investing. So if we build a portfolio where you have one multifamily in one city versus you have 5, 10, 15 investments throughout the year, smaller chunks, it doesn't matter, but it's a mix of bags, then it's better for you. You're mostly here. If you have some triple net, some new construction, some multifamily, Texas, Colorado, Florida, Arizona, what happens? Your investment portfolio has a distributed risk, so you are in this bucket. So whole goal from LP side, move from here to here. From us, when we underwrite the deal, systemic risk is just like everybody else, which is the operational value add, but we try to play with it and try to be on this side. And we don't want to be side. That means how do we avoid it? We don't push the rent too high. We don't push the CapEx too fast, and we don't cut the cost too much. And that's how we avoid the risk on the top end, and we bring the properties this way. So what it means, as an LP investor, you should always risk adjust your investment. That means you should invest in multiple assets. You should invest in multiple geolocations. You should invest in different assets investment cycle. Some should be 3 years, some should be 4 years, some should be 5 years. So you should look at it and invest continuously. Sorry, typo. Invest continuously. So that way your investment bucket, it's a better risk adjusted than anything else. That's why Massive always say, look, keep on investing. Don't feel like to invest 100 grand for a project? Fine, invest 50. Don't want to do it? Take 25 for this one, 25 for that one, that's one. Also from the Massive side, for our investors, we provide different type of projects, which is not the multifamily because we took intentional measure that it is one type of strategy doesn't work. All the big shops who have good grounding, they have multiple asset types, and we kind of went in with that. So then, again, and this is from the LP side, and then someone presents you an offer. How do you avoid this shaded area, right? What do you do? Again, the point today was the fund versus the direct. So if someone said, I'm a fund manager, I'm raising fund, you ask a couple of questions to get an understanding what does the fund do. I'll start from the bottom. Number 4, fund investment hypothesis. What is the fund doing? Is it to mitigate multifamily risk, or is it a pool of multifamily apartments, or is it a pool of retail? Is it a blended approach? Is the location? What is the hypothesis for the fund? Number 3, ask the fund manager how many times they've invested and how often they're investing and the typical return. So return really doesn't matter because that's in the market, but the frequency, the quantity matters. Because if someone underwrites a deal today, let me go back. If someone was underwriting up until 2022 and they stopped buying any assets or making offers and they come back and start underwriting today again, they're going to see a lot of problem because market changed, underwriting model changed. So if they don't make frequent investments at the fund manager, they'll be on the sideline, then they're not in tune with the market. And that maybe sometime will give you an extra risk. So the frequency of investing and the quantity really matters. And then also how many deals they're underwriting. To us, it matters because if I underwrite 3 deals, my view of the world is only 3 deals for a month. If I underwrite 30 deals, I had 30 flavors of deals in the same month. So, and right now, deals don't pencil out for most of the time. So right now it's more critical to underwrite even more assets as you go through. And last thing you ask, what's the cost of profit structure for a fund? Again, it gets kind of detailed, but I'll try to kind of bring you guys up a little bit. What it is. It's again, just ask those questions, and based on that, just see how you feel comfortable. Then you decide. If you ask me, I like fund, and I also like discrete because I'm building a portfolio as you go through. And also, fund gets you a better distribution of it, but it's a mature play, and fund triggers a lot of auditing, a lot of financial framework, a lot of reporting that may not be, I mean, the cost is too much. And that's why a lot of folks you'll see we don't do funds, we do discrete, it's clean, it's easy, and you go, right? Okay, so then the question is, how does the fund structure multifamily works? What the fee structure looks like as you go. So I kind of typed in some of the 4 different buckets of cost. On the top, you got the construction management, property management, asset management. That's standard. Doesn't matter what deal you do, you're gonna have it because teams gotta pay the back end office and the system and the tool and all this other stuff, right? And the last one is the fund management cost because fund is an additional layer on top of the project. So that fund needs to be managed. You got the back office and some probably they have analysts and extra accounting they have to do, extra tax they have to file, and that may have a cost. And it has a wide range of it. So as you get into a fund, you ask the question, what's the cost look like? And most of the deals that I have seen on the fund, it made sense. I haven't seen something crazy because most of the funds that are being started now, they come from your sponsors team. So they're biased to give they're biased to keep the cost very lean. So I have seen most of the funds that I've seen in today's market is pretty lean. Haven't seen anything unless you go to big shops, which is something like this. You go Merrill Lynch or Morgan Stanley or Wells Fargo, they'll charge an arm and leg for it upfront and then a bunch of other stuff. So again, with the multifamily, with the sponsor team, they're lean, haven't seen any crazy cost. The profit and the return was very reasonable versus you go to a wealth manager, hey, I'll give you 2% or 2.5% off your total capital investment per year, and then whatever it shakes out to be. So that's the idea. This is an example of how the cost structure looks like outside, if you choose to, and then usually fund costs are pretty lean, and but we wanted to introduce the cost and the framework to you. So because fund of funds are becoming a thing because that's the legal way of putting a deal together for a deal team to work and aggregate the cost. So it's that. So lastly, again, massive masters. So the question was, what do we do? We get asked all the time. We don't clearly share what does the massive masters do and how do we add value and from our framework. So on the massive master side, we have 2 I would say graduation flow. The first one is the fund manager or capital allocator. We do quite a bit of raise. We have syndicated 15 deals. No, 12, 13, 12 deals. 3 were JVs. So we are continuously deploying money. So we understand what the fund manager and the characteristics and what does it look like, and especially the SEC regulation perspective as you go. So creating a fund, it's almost like you have a whiteboard and you can draw whatever you want to draw. But for us, we've been through so many times. We have like 3 funds ready, like literally ready. We just have an executor on it, right? So we've been through enough to say, if you want to start, this is the framework look like. Talk to this attorney, go ask for this kind of things because you need to do why, and this is how you create your business hypothesis, and you go. Other one is the deal sponsor, which is equity raising and a fund manager plus all the other things that you have to kind of do to be a deal sponsor, especially on the asset management side. For us, asset management is a big deal. Oftentimes we underestimate the amount of work it goes because we forget that we have to live with that baby for 5 years. So it's a lot. So we have our own software. That's our platform of conversation. And both sides, you get the deal flow that we have. So for us, we're not in a place where I have to call a broker for the first time, build a relationship. That was 2 years ago. Now you walk into an established relationship and you run the shop so you can get to the destination faster. Yeah, and if you want to do deals on capital raise, then come over. We get into technical this almost every day, 4 or 5, 10 hours a day. And those are the 5 things that we provide. We call it Massive 5, which is the community, digital, and in person. We live off of text. And then we provide the training and education and everything on a case study, like you're going to business school. You want to buy a business, first thing you do, go study 60 other businesses. You'll have a flavor of what the business will look like. And then you go buy one, right? Multifamily is the same way. And go to the library, pick up the 60 properties you want to underwrite, and you go. And in our deal database, we have like almost 950 some odd properties we underwrote last 2 years. We give you tools and tactics because, it's a fiduciary duty for the deal sponsors to do everything right for the LPs. And it has a lot of tools and tactics. So we bring the corporate framework into our execution. We're going to use that and share our financial framework and asset management on May 18th in our day workshop. Then we have marketing and events and exclusive parks. So we have all of our cost. We have a pre-negotiated rate with the lenders. We have a pre-negotiated rate with the SEC attorneys, pre-negotiated rate with the vendors. We get away with it because we're doing 5 to 10 deals a year versus you do 1 or 2 deals a year. So our thought is, it doesn't matter who knows who. It really matters the depth of the relation that you have. So we try to drive the depth as much as we can as a part of that mastermind. That was a lot, and I kind of intentionally went quick. So we have 15 minutes. I'm open. I want to stop sharing right here. So let me see. Trevor, take it away, buddy.
That was pretty awesome. So a lot of information there. Clearly there's still probably a million questions. So I guess if anyone has any questions, go ahead and ask.
All right, so I have a couple of questions on the Q&A, so I'll answer. The first one, I think everybody can see, right? It's a foreign investment fund, right, Trevor? Can everybody see those questions?
I don't see them, so maybe if I don't see them,
I'll share.
there they are. I gotta find them. Okay, sorry.
All right.
Yeah.
So question was, would there be a double promote for the investors to pay? The answer is yes and no. Yes, you have the double promote. And no, in a sense, because that fund manager will negotiate a higher return. So cost adjusted, you should be in the same ballpark. So depending on how the fund is created, so you may or may not, right? That was the part A of the question. Part B was investors have no control of investment portfolio. The answer is yes. You don't, because you already bought into the concept by understanding what the investment hypothesis of the fund is, right? If the fund says, I'm going to buy 5 assets in Houston, where from Houston I'm using it, then if you come in and invest into the fund, you already approved the fund managers to go buy 5, right? And also you already approved the fund managers, the requirements of those buy. So when you come in, you already signed off by saying that I approve the fund hypothesis. I believe it. Here we go, execute. And then, we're going to come back. Now, if you don't, that's a different case. So again, that's why I was mentioning fund is a little bit more mature play. You have to think it through and you go. We like fund. One of the biggest thing that for a fund manager got to have when they create a fund, they have continuity of deal flow. So you can continuously deploy the fund. If you don't have the continuity, thing is going to fall off, right? So that's that. Second question is, how do investors completely exit in a fund? Do all the properties have to be liquidated? The answer is, again, yes or no, depending on how the deals are being structured. If the structure said every time there's an exit and all the capital goes back, then you exit. And if the fund says you stay in all the way, then you stay in. And if the fund says it's time driven, then it's a blend between the time and the exit. So most of the funds that we have seen, it's par exit within it. It's not the whole fund exit. It's just like a waterfall. They bought 5. If number 1 be sold, they return a proportional amount. Number 2 sold, they sold a proportional amount till they exit all the way. So yes, no, not all the property, they don't have to be liquidated. Okay. Randy asked a question. So good questions. I love these guys. Okay, let's talk about additional amount of fees going to the GP for fund compared to individual offering. How to see this? Okay. That's a long answer, but I'll try to simplify it as I go through. And then let me share my screen. That'd be good. Looks really awesome. I love those questions. Keep them coming, and we're going to try as much as we can. Again, full disclaimer, I'm not an accountant or CPA or a legal person, so read your own fund document, pay somebody to read it, but I'll try to answer it as much as I can. And let me talk about it here. Okay. So additional fee that goes in. So yes, typically I have seen 90-10, that 10% of the fund return gets allocated for the backend system, right? Because you have 2 layers of accounting, 2 layers of reporting, 2 layers of setting up the legal doc. Each expense is there. So let me use an example. If someone sets up just a syndicated doc, let's say it takes about $15,000. But if you do an SPV, it takes 15 plus 5, right? So it's about $20,000. That SPV will cover the $5,000. Now on a fund, it alone is $15,000. So if someone invests via the fund into a deal, so the deal already spent $15,000 to get the syndication doc ready, then the fund will do their own syndication and will come about. So yes, there is a cost, but once you bring in $2, $3, $4, $5, $10 million, that cost really becomes thin margin all the way. And if the fund manager is good, they're gonna say, hey, investor ABC gave $50,000. Let's give them the 17% return as a baseline. But hey, I'm the fund manager. I'll give you $2 million. Can I get 2 extra percentage? Most of the time, that's the way waterfall is set. More money you bring in, more concentrated risk, higher the return. And fund managers still will pay you that 17% just like in other investors, but they will take the additional spread because they are bringing in a lot more money and they're helping the project more. So it's kind of, then GPs will take from their share and pass it on the fund. So it's a good thing if you know what you're doing. If you don't, that's problematic. But if you do know, then funds are good. If the fund manager is good, then fund is good. So the maturity of the manager will set the tone for the fund as you go. Okay, there's a minimum investment in the fund, and there's I have seen from 50K to $1 million. The XSpace guys, they changed the business model. We're the one with the syndication. Then they flipped it to a business model, and it's like $500,000 to $1 million at a time to come in. So they had individual investors come in at $1 million, and based on the fund, I have seen a lot more. There's no end of the high limit, but minimum will be 50 grand to 100 grand. So 50 seems to be pretty usual as you go. If it's a 506B fund, it's higher. If it's a C fund, it's lower. That's the standard. Okay. All right, I have 18 questions. No, 18 people. So thank you. I love those questions, and let me kind of go through those as I go. Yeah, please do the polls, right? Thank you. So yes, I think we covered most of the questions that we have, and so let's keep asking away. This is good.
Yeah, so I think one of the questions there on the funds, you've got to assume a little bit more sometimes with a fund. You've got to assume that your fund manager is skilled and done their homework, and their homework is on the sponsor themselves. And so you're trusting that, okay, listen, this is the person who's doing this as a business for you. They are making all of the kind of the decisions for you, right? They're vetting the sponsor, they're negotiating everything. So it can be or it cannot be. Again, doesn't mean you have a better deal. I've invested, and this person has several investments. The whole 7 deals have gone bad. The main sponsor stopped communicating to him as a fund manager and basically sold the asset and put us all in a second position. And would that have happened if I'd invested directly? Probably, but I don't know.
Yes, I mean, on that note, look, if I'm an LP right now, let's do some role play. If I'm an LP, what I'm doing, I'm going to an education that I need to know the terminologies. That's like coming into the investment. And then I am looking at all the sponsors and vetting them out, trying to understand. And then on top of that, I'm trying to understand the deal. So it's like a 3 steps learning before I get to investments. A fund manager should be solving it for you, the deal and the sponsor team. And that's their role. They're identifying the better projects with the stronger operators. So as an investor, when you come in, you don't have to go knee deep into learning 10 indicators and then all the ways, because the learning curve has time and risk associated with it. So Randy, your point is right. If a fund manager does the job right, they are going to do your homework, hence the provided value, hence the profit sharing that they offer as you kind of go through. That's right. So if a fund manager doesn't know anything, then it's a different case, right? If I'm fresh out of school, I haven't done it in syndication before, I worked for a PE company for 2 days, I want to raise $50 million, highly risky, right? They haven't done anything yet. Versus somebody say, hey, I worked with CBRE or JLL or a PE company. I've done, and I have within the umbrella, I have done quite a bit of investments, and I know what the good, bad, ugly looks like. I have a structure. I know it. Now I want to do my own because I think I can do a better job, a better cost-efficient job than you go, right? So that's the whole thing. And okay. So the last question. One of the other questions we had, how did fund manager perform the fiduciary duty for the investors? They have a fiduciary duty to perform, or it's that the biggest fiduciary duty will be stick with the PPM that they have promised. If they have promised to bring in deals more than an X IRR and a Y market by taking the reviewing the deal and the sponsor team a certain way, as long as they have done it, then they are doing the initial deployment of the fund. Second thing, what we see the most of the time, the lack of, is the reporting, right? You got to stay close to the investors. Doesn't matter the deal is good, bad, or ugly, right? All of us were in it. If I'm promising to get to somewhere 9 o'clock, I hit 2 potholes. It's not in my control, but guess what? I'm going to communicate I'm running late. If I have one spare, fine. One time I got away with it. Second time I'm calling help, right? As long as you communicate, as long as you stay around with it and you go. So for Massive side, we are loyal to only one set of people, which is our LPs. And for some of you guys who have done deal with us, you know how much we feel about it. We are happy to be an activist investor as you go through, as long as our LPs are protected. We are more than happy to go have those tough talks with the other partners and other good stuff, as long as our LPs are protected, and if we feel like they're falling short of their delivery was, right? So the fund manager's sole job is to do everything right and protect the share for the LPs. In other way, be like a broker. Multifamily sales broker, what their job? Get the most dollar out of you, and they're good at it. And as a fund manager, that's your role. Stay close to investments and get the return out of it, and stay on top of the syndicating team. Make sure they're delivering what they're supposed to deliver. Okay. Thank you. I appreciate it, Richard. Thank you, Steve. And Steve had another question. What kind of resources do you recommend to learn more about funds? It's hey, you can start with the YouTube University. That's the first place. It's a wide zone to go, but then you got to narrow down with the folks who are doing deals, right? And my mentor used to say all the time, you can watch the game and win a tournament sitting on a stadium because that's easy. It's not the same as when you're in the game, the 2 billion people looking at you and you're calling the shots and the shot didn't come out right, right? So what you do is you go pick a set of group of people who are doing deals actively and you go get into that circle. And the faster you can get into that circle will be better for you because you're going to learn, right? We always say, get into a mastermind, maybe 2, maybe 3. Every single education platform provides different kind of value. Some will do syndication only, some will do JV only, some will do blended. And for us, we do everything. But just pick a group, go in the group, and you'll have a better view when you're really close to the game as you go. Appreciate it, Tracy. Let me see. Okay. Yeah, very good questions. Look, funds are the new hot thing. And so you need to know more about the funds, how the information flows, how you go about signing those docs, what the cost looks like, and that's very important. So keep on investing, but but continue to ask those questions as you go. Great.
Awesome. We actually got done almost by 7 o'clock here. It's kind of a miracle. There was a lot of information. I was a little worried when I first started looking at slide deck. I'm like, well, there's a lot going on in here. But we're still going to hang out for a little while for sure. And I'm going to end the poll in 1 minute. So this is the last getting to know you one. We're almost at 60%. So thank you. One of the things I want to mention is we do these webinars and we try to provide information where, like someone said, where do I find information about this? We want to provide, we want those types of questions. So that's part of the reason why we do the polls. That's part of the reason why we try to have you book calls with us. We want to know what you want to know. And then that's how we plan these sessions. And you know, that's what we do. If you enjoyed tonight, if you learned something, invite a friend to come and join us next week. We do this every Wednesday night.
Trevor, thank you. And Adam, 100%. It's license to stay in a business will be doing deals. And doing deals is an art. It's just not possible at all cycle. But if you do the right things, it should be possible at all deals. But doing deals is very important. And the way we are structuring a financing today is not the same as before, right? So unless you do it, you don't know.
Yeah. Yeah, and it's quite interesting, even though funds is the new hot thing. So I've invested 31 times for those that don't know, and only once in a fund. And so for me to say, oh, I didn't have a good experience is it's slanted, right? Because I only have one experience. And you know, it's the whole gamut, you know. Because I've had amazing experiences on a direct, and I've had disappointing experiences on direct, right? So don't ever forget who you give your money to is the most important thing that you can do is find the who and get to trust and like the who.
I invested, so I do before I came into, the real estate, I was an angel investor and or seed investor, a bunch of startups before. So I've invested in the funds before, and those are high risk, high profit type. So I understand the beta. So I used to do option trading. The funds are not bad. Funds are great vehicles as long as you understand what you're doing, right? And as long as you understand, and at least close to understanding how the information flows, and you kind of go from there. So yes, nothing wrong about good, bad, or both, but it just sometimes it makes sense to invest in fund. Sometimes it just doesn't because you go directly into the deal and it works out, you know. And also sometimes it's a matter of availability, right? Is it available today to invest a certain way? Hold on. I got two more questions. So
Oh, sorry.
Randy, absolutely, you're welcome. So nobody, please do not feel that way. You're bugging, yeah, because trust us, when you ask a question, there are about a dozen other folks thinking about the same thing. They're just not asking. So you ask, we'll answer as you kind of go. In today's environment, my feeling there are a lot of fund investments from the last year. Now they'll cut because fund has to deploy by capital a certain date. Yes, yes, it is. There's lots of dry powder on the sideline, but those are really institutional grade money. Those are not a retail side money where they're typically what we see here. The BlackRock, they bought $10 billion and they invested and bought out a REIT. That's that type of money. We have, last time I saw in one of our virtual conference, there are about a little over 200 funds and there's some odd $1 billion ready and there. And yes, and also at the same time, those funds are working. I'll give an example. Last year, we started working with the loan servicers to start building relationships to see if you can get some back-end view of the properties. So we have big lenders like Arbor, but Lument, and a bunch of other guys. They work directly with the funds already. They have been working on it. They know it because projects are going bust, but they're not going to go to market. They just make one phone call, look at the process. They're coming and buying the property at par. Everybody moves on. So those funds are being worked on. They are working their stuff. They are buying assets. Deals are happening. May not be in front of us, but funds are doing the fund job. So again, depending on strength of the management of the fund and depth of the fund, it's being there. And you're right, they have a pressure, but they get away with it because they also have lower cost of capital. That means when we raise, we pay 17 to 20% return on the equity side. For the same amount of dollar, they will pay maybe 8%, 10%. So they can do different type of projects what we can do. That's one. Dirk, thank you. Appreciate it. TWA Expo, I may miss it. I'll be in California. I'm speaking in IMN conference, and it's a CFO and COO forum for within the all real estate company. All the CFOs and COOs come twice a year in Dana Point, California, and we talk about stuff. Massive is the young buck in the room, probably. Yes, I think. So last time we get to, in my panel, we had 4 panel members, me and 3 other publicly traded companies CFO. It was interesting how they go about it versus us. This panel, we have 3 members. One of them is a publicly traded company, and it's good to go. So I'll be there. Then we'll be in New York talking to some institutional funds next week as well. So I'll meet you there. Randy, I mean, do fund managers have burdens deploying capital within? Yes, they do. And the good fund manager will tell you, hey, I cannot deploy the fund. Go take your money back, right? That's all. Okay. How long do they typically? Okay, Randy, ask the question one more time. That how long do they typically have for? How long do they keep the money, or how long do they keep the money? I'm not sure.
How long do they have to deploy the capital? That would be specified in the agreement.
In the agreement, yes. It depends, guys.
Yeah, so they would put it in their disclosure.
Yes.
And if they had to make a change, I think they would have to ask, correct?
That's correct. It's a revision of PPM, and you go. Typically, when you draft a PPM, it's almost like you have some window of movement, and so that means, hey, I'm going to, and I'll buy projects with X% IRR plus minus some percent. So as an operation, you have some breathing room. Same for the timing. And most of the fund that we're seeing now, just to kind of give you clarity, there are 2 kinds of fund that's coming in, which is one is SPV. That means they're aggregating money and following the SEC guideline, and you go. So from the GP side, we see a lot of SPV because SPV, you can have a fundraising, capital raising as a business and do the right thing. At the same time, you can get compensated without being actively partnering in the deal. So that's why we see a lot of SPVs. And also for the fund, most of the time, what we have seen that they already have a destination set up, but they're just continuously buying, and they don't want to wait after the deal. They want to build confidence on doing the deals. That's why they start the fund, gather the money.